Hello, and welcome to HouseLux Estate, your go-to channel for everything real estate investment related. Here at HouseLux, our mission is to empower you with knowledge, strategies, and insights to make informed decisions about your investments. Today, we'll be diving into the world of real estate investment trusts. We'll explore what they are, how they work, and most importantly, how you can leverage them to generate a steady stream of passive income. So, stick around to learn how you can start earning passive income through real estate investment trusts. Before diving into the process, it's crucial to understand what real estate investment trusts, or REITs, are. Think of REITs as mutual funds for real estate. They are companies that own, operate, or finance income-generating real estate. By pooling the capital of numerous investors, REITs allow individuals to earn dividends from real estate investments, without having to buy, manage, or finance any properties themselves. REITs can be publicly traded on major exchanges, or they can be private. Public REITs are highly liquid, meaning they can be bought and sold like a stock on an exchange. Private REITs, on the other hand, are only available to accredited investors and are not as easily traded. The beauty of REITs lies in their diversity. They can invest in a wide range of real estate sectors, from shopping malls and office buildings to hotels and apartments, and even hospitals or data centers. This allows investors to have a piece of these properties without the need to own them directly. Now, why are REITs a good investment option? Well, they offer several benefits. Firstly, they provide a steady income through dividends. By law, REITs are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. Secondly, they offer the potential for capital appreciation. As the value of the properties in the REIT's portfolio increases, so does the value of the REIT's shares. Thirdly, they offer diversification. Since real estate is a different asset class than stocks and bonds, it can help spread risk in an investment portfolio. Lastly, REITs offer accessibility. They allow anyone to invest in real estate, even if they don't have the capital to buy properties outright. In conclusion, REITs are a unique investment vehicle that combines the potential for growth, income, and diversification. They offer a way for everyday investors to benefit from real estate without the need to buy or manage properties themselves. Now that you understand what REITs are, let's explore how you can invest in them. Step 1 in your investment journey is to do your research. Research is the compass that guides you through the vast ocean of investment opportunities. Without it, you're sailing blind, and that's a risk you don't want to take. When it comes to real estate investment trusts, or REITs, research is not just important, it's essential. Start by exploring different REITs. Get to know their structure, their portfolio, and their management. Some REITs are focused on commercial properties, some on residential, while others might have a mix. Each has its own unique set of risks and rewards. Consider their performance over the past several years. Look at how they weathered economic downturns and how quickly they rebounded. Remember, past performance is not a guarantee of future returns, but it can give you a sense of a REIT's resilience and management's ability to navigate challenging times. Evaluate their potential returns. What's the yield? How do they compare to other investment options? But remember, higher potential returns often come with higher risks. It's a balancing act, and your research will help you find that sweet spot. And don't forget to consider the tax implications of investing in REITs. They can be complex, so don't hesitate to consult with a tax professional or financial advisor. Once you've done your research, you're ready for the next step. The second step in the process is to choose a brokerage account. Now, choosing a brokerage account isn't as daunting as it may seem. It's all about finding the right fit for your investment goals and comfort level. Let's start with fees. While many brokerage accounts have moved to zero commission trades, there are still other fees to consider. Look for any account maintenance fees, inactivity fees, or transfer fees. These costs can add up, so it's important to understand them before you commit. Next, consider customer service. Investing can be complex, and you'll want a brokerage that offers robust support when you need it. This could be in the form of live chat, a dedicated phone line, or even in-person assistance. Remember, a good broker is responsive and helps you navigate through any potential hurdles. Finally, think about platform usability. Is the platform intuitive? Can you easily find the information you need? If you're a tech-savvy investor, you might appreciate a brokerage with a sophisticated trading platform. On the other hand, if you're a beginner, you might prefer a simple, straightforward interface. Choosing a brokerage is a personal decision, and what works for one investor might not work for another. Take your time to consider your options and choose a brokerage that aligns with your investment goals and trading style. After you've chosen a brokerage account, you're ready to invest. Your journey to passive income through real estate investment trusts is just getting started. Stay tuned for our next steps. The third and final step is to start investing. Now that you've done your research and chosen your brokerage account, it's time to put your money to work. Purchasing shares of a real estate investment trust, or REIT, is as simple as buying shares of any other company. You'll need to log into your brokerage account, search for the REIT by its ticker symbol, and then decide how many shares you want to buy. Remember, the price you see is per share, so make sure you've done your math correctly. Now let's talk about diversification. This is a key concept in investing that helps you manage risk. Diversification means spreading your investments across different assets, so you're not putting all your eggs in one basket. In the context of REITs, this could mean investing in several different trusts, each focusing on different types of properties like commercial, residential, or industrial. By diversifying, you're not only spreading your risk, but also potentially increasing your opportunities for return. If one REIT underperforms, it might be offset by another that's doing well. Remember, investing always comes with risks, and it's important to be comfortable with the level of risk you're taking on. Always consult with a financial advisor if you're unsure. And there you have it, you've now invested in a real estate investment trust. Before we wrap up, let's quickly summarize the key points from this video. Investing in real estate investment trusts, or REITs, is a viable path to generating passive income. REITs are companies that own, operate, or finance income-producing real estate. They offer the opportunity to invest in a portfolio of properties without the need to buy or manage them yourself. The first step towards investing in REITs is research. Knowledge is power, especially in the world of investments. It's crucial to understand the different types of REITs: equity, mortgage, and hybrid, each with its own level of risk and return. Researching each type, their performance, and their potential for future growth can help you make an informed decision. Step 2 involves choosing a brokerage account. There's a wide range of options out there, from traditional brokers to online platforms. Each offers different services, fees, and interfaces. It's important to select one that aligns with your investment goals and comfort level. Step 3 is where the fun begins, starting your investment journey. However, remember that investing is not a sprint, but a marathon. It's about long-term growth and income, not quick wins. Diversification is also a key element in this process. Don't put all your eggs in one basket. Diversify your investments across different types of REITs and other investment options. This can help mitigate risk and increase your chances of achieving stable, passive income. Finally, let's stress the importance of patience and consistency. The world of investments can be volatile, and REITs are no exception. Yet with thorough research, strategic planning, and a dash of patience, you can navigate this landscape successfully. Remember, the aim is to generate passive income and secure financial freedom. So take your time, do your research, and make informed decisions. Thank you for joining us today on House Lux Estate. Don't forget to subscribe to stay updated on all things real estate investment.